The Bank of England Deputy Governor Paul Tucker has put forward the idea that they should take the interest rate and make it negative. Now, he said this was something that they were considering along with a lot of other measures. But this gives us pause to think. What does it mean to have a negative interest rate in a country? To understand the impact of having a negative interest rate, we must first understand how it is that a country comes out of recession, because we do have to understand the context. Right now, the whole world, England, much like everybody else, is facing a huge recession. Meaning, right now, our economies are not repairing. The one thing above all else that repairs an economy in capitalism is the investment in businesses to begin production once again, preferably physical commodity creation, because commodity production is the only thing that holds any value. But the point being, investment in starting up firms, manufacturing, even services has to begin in order for the country to recover. Now, the only way that happens is by taking a loan from the bank. The problem is, banks aren't giving out those loans because the economy's bad. But the economy can't recover until those loans are made out. But they're not giving out the loans because the economy's bad. This is one of those really silly contradictions of capitalism that Marx did speak about. The whole idea is one gigantic contradiction. So what remains is that the money has to be given out. Now, what does this have to do with a negative interest rate? Well, one of the things that's done to incentivize getting that money out so that people can begin investing is to lower the interest rate. Now, that's one of the things that's done to get people to get. I mean, there's a low interest rate. You'll have to pay less back if you enter into production. So it incentivizes it. So it's cheap. Go ahead and do it. But the thing is, it's not being done. Even with the low interest rate, the money is still not being sent out. In other words, it's not being borrowed. The banks are not lending it out. Now, aside from the banks not lending it out, there's one thing that bourgeois economists tend to overlook when dealing with recession and interest rates. You can make the interest rate as low as you want. You can make it zero, where essentially they're just taking money and have to pay back the original investment. The thing is, if a capitalist or the person investing in production doesn't see a possibility of making profit, the interest rate doesn't mean anything. Even if the interest rate is zero, if the potential for profits is zero, they're not going to borrow the money and enter into production. Thus, we can see that lowering the interest rate doesn't necessarily work. So what would a negative interest rate do for banks? Well, for one thing, it would charge banks for having money, meaning they would have to pay for having money. Well, what would this do? Well, for one thing, it would incentivize them getting it out. If they get the money out and loaned, then they would pay less for holding that money. In a sense, it's a mechanism that would force them to make the loans that they should be making and are not. Actually, surprisingly, that this has come up as I am in the middle of writing a book on inflation and some of the incorrect Friedmanite assumptions surrounding inflation. And a part of that book, I was actually talking about the necessity of having to have a mechanism to force loans to go out when banks are not agreeing to do so. So it's actually very good timing. Now, while this would force the money out into the economy, into loans that need to be made in order for production to begin again and thus begin the cycle of repairing the economy, this can have some side effects, and those side effects can actually be very dangerous in certain circumstances. A negative interest rate will definitely have a negative impact on people who save because it will cost them money to save money. But in essence, what this will do is in some cases, will actually force them to go out and spend that money, put it into the economy, purchasing hopefully finished goods and services, and hopefully not secondary financial asset transactions, which are non-reproducible and wouldn't generate new wealth and wouldn't stimulate production. However, a study has been done on negative interest rates before by the New York Federal Reserve Bank, and this is some of the conclusions they came to that they think would likely happen in the case of a negative interest rate. The largest denomination bill available today is the $100 bill. It would take 10,000 such bills to make 1 million. 10,000 bills takes up a lot of space, are costly to transport, and present significant security problems. Special purpose banks would spring up, holding nothing but cash in a very large vault. A taxpayer might choose to make large excess payments on her quarterly estimated federal income tax filings with the idea of recovering the excess payments in the following April. A credit card holder might choose to make a large advance payment and then run down his balance with subsequent expenditures, reversing the usual practice of making purchases first and payments later. I might even go to my bank and withdraw funds in the form of a certified check made payable to myself and then put that check in a drawer. People receiving payments will prefer checks, which can be held back from collection, to electronic transfers. One of the things that we might see as a result is people making unproductive expenditures with their money that, while they're personally beneficial, they're completely unproductive, like, as I said, taking hold of secondary financial asset transactions. Another definite concern that we would face is that banks would start to lose money. I mean, it would cut into their profits having money held in their bank. Now, what they may end up doing, because, well, capitalism is a system based on greed and self-interest, they may turn around and start increasing service charges and charging people more money for having money in their account and pay less to them in the end. Like, this could definitely end up hurting the consumer if the bank chose to do so to make up for the money that they would be charged for holding the money that they themselves were already refusing to give out to begin with. This proposed action by the Bank of England is very telling, and it says a lot about the situation that we're in right now. Banks will normally do what's in their interest and hopefully what is in the interest of the rest of the economy. Now, it's obviously good for a bank if the economy is strong, because if it's strong and there's a lot of business going, it's good for the banks because they can make money. However, we're seeing in this situation that the banks are not doing what's right for the economy. They're thinking only about themselves and not about the long-term problem of not loaning this money out. They are deliberately withholding the actions necessary to repair the economy because it's in their interest not to do so. I mean, I've said this previously with the problem of quantitative easing. The banks are taking this money from the central bank, but then not loaning it out and simply writing it as profits to themselves. So they're still doing financially good, but they're supposed to be loaning the money out, but they're not doing it. Now, the thing is, what I advocated at the time was that there be some kind of a mechanism to force them to put the money out. That's exactly what this is. It's a means by which the government can force the banks to make the loans that they're supposed to make in order to repair the economy. Think about what that means. We are now at a point where the government has to threaten the capitalist class into repairing the economy. Now think about the magnitude of what that means. The capitalist class, the very, very top, the financial aristocracy, are hurting the economy and they don't care. It actually requires an act of force by the government, who is in the service of the capitalist class, to force them to do the thing that is necessary to repair the economy. Now, while the state has always been the mechanism of the capitalist class in a capitalist country, this shows a very radical thing that's happening here. The state is essentially threatening the capitalist class into doing what is right because they won't do it on their own. And I think that's an important thing to keep in mind when we consider what the real impacts and what the reality is of a negative interest rate. Hey Mouse Rebel News fans, I just wanted to let you know that I've released a new ebook debunking the claims made by Trevor Luden that Barack Obama is a communist. He made a challenge that if anybody could refute his proof that Obama is a communist, that he would stop calling him one and take his own book calling him one off the market. So if you want, head over to the MRN bookstore on lulu.com and check it out.